How do economic indicators guide fast commodity trading? Imagine trying to catch a train just as it starts moving faster. In commodity trading, economic indicators are like signals that tell traders when the train is about to pick up speed. These indicators give clear, measurable data about how the economy is doing, which helps traders make quick decisions. When they understand these signals, they can buy or sell commodities at just the right moment to make a profit. Economic indicators include things like inflation rates, gross domestic product, employment data, and industrial production. Inflation shows how fast prices are rising across the economy. When inflation goes up, traders often buy commodities like gold or oil because these are seen as safe bets against currency losing value. Gross domestic product measures the total value of all goods and services produced in a country. If GDP is growing, it usually means more factories are working, and demand for commodities like metals and energy increases. Employment data, including how many people are unemployed or how many jobs are added each month, gives clues about how strong the economy is. When employment is high, people tend to spend more, boosting demand for commodities. But if unemployment rises, demand might slow down, signaling traders to be cautious. Fast traders keep a close eye on these indicators and react quickly when new data comes out. For example, if a country reports a higher than expected gross domestic product, traders might buy industrial metals immediately, expecting factories to need more raw materials. If inflation numbers show a sharp increase, traders might rush to buy gold or energy products, expecting prices to rise further. Surprises in economic data, when actual numbers are much different from what was expected, can cause sudden jumps in commodity prices. Traders who spot these surprises early can buy or sell before the wider market reacts, making quick profits. To do this well, traders use economic calendars to track when key reports are released. They prepare strategies ahead of time based on what the data might show. Combining different indicators helps them see the bigger picture of economic health. For example, if inflation is rising but gross domestic product is slowing, traders might shift their focus to commodities that protect against inflation, rather than those tied to industrial growth. Since commodity markets are connected globally, economic news from big economies like the United States or China can influence prices worldwide. In short, economic indicators are like a compass for fast commodity trading. They give timely signals about how the economy is moving, which directly affects supply and demand for commodities. Traders who understand and interpret these signals correctly can anticipate price changes and act swiftly to take advantage of market shifts.